and they're making money off the global Cantillon effect. So they can borrow cheaply dollars from private banks in the US at, let's say in the 70s, let's say maybe it was 5%. And then they would loan it out to poor countries at 8%, and they would take the spread. So this is kind of how these institutions were operating. They were lending for different purposes, making money off that. And often, given the high interest rates throughout that period, especially in the 70s and 80s, and given the length of some of these loans, like IMF loans were supposed to be short-term, 2, 3, 4 years, but they would often go through something called the Paris Club, which was a place where poor countries would go to like ask for an extension. So some of these IMF loans were really extended, and World Bank loans were like 10, 20, 30 year, sometimes 40-year loans. Okay. So when all was said and done, you might have had a country borrow $1 billion and have to pay back $1.5 billion in the end after all the interest. So it's important to note that like these are not no strings attached gifts. These are loans where the borrower is going to have to pay back more, and sometimes a lot more than what they borrowed in the first place.